Hello everyone, John AG here, and I need you to hear this clearly. The wealth shift already started, and it's not polite, it's not slow, and it's not waiting for you to feel ready. Exactly what happened is simple. A massive wave of inheritance and asset handoffs has begun as older households age out of the workforce and out of life, and their money is moving, quietly, legally, relentlessly, into new hands. And the moment that money lands, it has to choose a home. That choice is where people win or lose. Because if the next generation parks this cash in the same old paper system, inflation and taxes chew it up. If they position it into assets that don't get printed into oblivion, they keep it, and in many cases, multiply it. So in this video, I'm going to break down what this 45 trillion shift really means, why the next 24 months matter so much, what the paper markets don't want you thinking about, and why silver keeps showing up in the middle of this story like a trapdoor that suddenly opens under the entire financial system. And before we jump in, quick reminder. If you want more content like this, tight, practical, and focused on what actually protects buying power, hit subscribe. Short and simple. Subscribe so you don't miss what comes next. Now, let's get specific because vague talk is useless. The claim is that tens of trillions are transferring from older generations to Gen X and Millennials in the coming years, and that a large chunk of that transfer is front-loaded into the near term rather than evenly spread across decades. When people hear that, they nod. And then they do nothing, because big numbers feel like someone else's problem. But this becomes your problem the moment a family estate settles, a property is sold, a retirement account is liquidated, or a parent decides to gift assets while they're still alive. That's not theory. That's a weekly reality for millions of households. Here's the first cliffhanger. What happens when that inherited money hits an economy drowning in debt, where the easiest political move is to quietly devalue the currency? Because the government doesn't need to confiscate your money to take it. It only needs to make each unit worth less. Think about it like this. If you inherit a number on a statement, say $250,000, and prices keep rising faster than your interest, that statement becomes a shrinking ice cube. It looks stable, it feels safe, and it melts anyway. Now zoom out. Debt levels, interest costs, and repeated emergency liquidity operations create the same pattern over and over. When the system wobbles, authorities print, lend, or backstop, and the currency takes the hit. That's how modern stability is purchased. And that brings us to the real question. Where does this wealth go when people stop trusting paper promises? You already know the usual answers. Property, businesses, land, collectibles, and precious metals. But the real game is not just own something real. The real game is own the thing that is scarce when everyone tries to buy at once. Because during a wealth transfer, everyone suddenly becomes a buyer at the same time. Not literally everyone, but enough people to move markets, crush inventory, and spike premiums. And that's where silver steps onto the stage. Not because it's trendy, not because it's shiny, because it sits at the intersection of money and industry, and it's one of the few assets that can be both hoarded and consumed. Gold gets stored, silver gets stored and burned. And if you don't understand the difference, you miss the setup. Let's walk through the transfer itself. You've probably heard a bigger number, something like over $100 trillion over multiple decades. But the reason people fixate on the near-term 45 trillion estimate is because it frames a decade-long surge, not a slow drip. That decade frame changes behavior. Advisors don't plan for it like a distant trend. Families don't treat it like a far future. It becomes immediate. It becomes, what are we doing with this now? Now add in the quiet killers, inflation, taxation, and the forced selling that happens when estates get settled. When someone passes, assets don't just magically move. They get liquidated, divided, reallocated, and often converted into cash first. Cash is the most temporary form of wealth in an inflationary cycle. It's a hallway, not a home. So inherited, cash flows into decisions, and those decisions create price action. That's why you've seen hard assets get bid up over the last several years. Some of it is speculation, sure, but a lot of it is a desperate search for anything that can't be expanded by keystroke. Now, here's the second cliffhanger. What happens when the next generation realizes the safe choice, bonds, savings accounts, broad index funds, may not be safe in real terms, even if it looks safe in nominal terms? Because if inflation is running hot, a safe 4% yield is not safety. It's a guaranteed loss with nicer packaging. And that's how the next generation gets pushed into alternative assets. Not because they love risk, but because the traditional options don't protect purchasing power. Now let's talk silver, but I'm going to do it in a way that doesn't bore you. First, understand the psychology. Silver is weird. At low prices, people ignore it. At medium prices, they argue about it. At high prices, they panic buy it. And the panic phase is where markets snap. Why? because silver is physically smaller and cheaper per unit than gold, so it becomes the entry point metal. When new money floods in, silver is often the first choice for people who want tangible wealth but can't or won't allocate to high-priced gold ounces. That doesn't mean gold is irrelevant. It means silver is the pressure valve. Now, the script you provided anchors around silver in the high double digits and points toward much higher levels. I'm not asking you to believe any single price target. I'm asking you to understand the mechanism. A tightening physical market plus rising demand plus a giant wealth transfer equals a scramble. And scrambles don't care about your comfort level. They care about inventory. Here's the supply side reality in plain language. A lot of silver doesn't come from silver mines. It comes as a byproduct of other mining, copper, zinc, lead. That means silver supply doesn't automatically surge just because the price rises. So if the price doubles, the world doesn't suddenly dig twice as much silver out of the ground next month. Supply reacts slowly. Demand can spike fast. That mismatch is where repricing happens. Now, demand. Silver is not just an investment story. It's an industrial necessity. Solar, electronics, medical uses, advanced infrastructure. Silver gets used up. Some of it can be recycled, but not all of it is economical to recover, especially when it's distributed in tiny amounts across millions of devices. So year after year, a chunk of silver disappears into products that don't get melted back down. And at the same time, investors treat silver like a financial lifeboat. Industrial demand plus investment demand is a dangerous combo for a market with limited supply elasticity. Now, let's connect it back to the wealth transfer. Imagine you're inheriting money. Maybe it's $25,000. Maybe it's $250,000. Maybe it's $2. $5 million. The first question isn't, what do I buy? The first question is, what do I want this money to do for me? Most people answer, I want it to keep its value. Okay, then the next question is, what destroys value? Inflation, taxes, fees, poor timing, panic selling, fraud. Now the next question is, what protects value when those forces rise? Hard assets, productive assets, scarce assets. Silver tries to be all three. That's why it keeps getting pulled into the conversation. But here's the third cliffhanger. If silver is so obvious, why isn't everyone already all in? Because the paper market confuses people. Because the headlines flip weekly. Because banks publish forecasts that sound official. Because investors confuse volatility with risk, even though volatility is often the price you pay for upside. And because most people are trained to outsource thinking. They want permission. They want a green light from an authority. Meanwhile, wealth moves without permission. Now, let's address the idea of the gold to silver ratio because it's one of the simplest ways to see relative value without obsessing over exact dollar prices. The ratio is basically how many ounces of silver equal 1 ounce of gold. When the ratio is high, silver is cheap relative to gold. When the ratio is low, silver is expensive relative to gold. The point isn't to predict the perfect ratio. The point is to see the direction of pressure. If the ratio compresses, silver is catching up. If it expands, gold is outpacing. Now, you can argue about history all day, but here's what matters. In moments of monetary stress, ratios move fast, and they can overshoot in both directions. So when a giant pool of new capital is deciding how to protect itself, silver becomes the small door a lot of people try to squeeze through at the same time, and small doors jam. Now, before we go deeper, I want to slip in something creative like I promised. If you also want silver-related success stories, real examples of how people built wealth and protected it, there's a link in the description to another channel that focuses on exactly that. Go check it out and subscribe over there too, because sometimes the best lessons come from watching what actually worked for normal people. Okay, back to the core story. There's a timing element here that people underestimate. The wealth transfer isn't a smooth line. It's lumpy. It spikes around certain years as demographics hit critical ages. It surges with estate settlements. It accelerates when markets scare older holders into rebalancing or liquidating. So if you're trying to wait for a perfect entry, you may be waiting while the wave hits, and that leads to the most painful sentence in investing. I knew it, but I didn't act. Now let's talk about the paper versus physical gap, because this is where the story gets spicy. Paper pricing is what you see on a screen. Physical pricing is what you pay for metal that you can actually take delivery of. In calm periods, those two prices are close. In stressed periods, the gap widens. Premiums rise. Delivery times expand. Some products disappear. And if the gap gets big enough, the screen price becomes almost meaningless for real buyers. This matters because when the next generation inherits wealth and decides to buy real things, they don't buy paper. They buy items they can hold, store, or use. If 1 million new buyers show up and want physical silver, they can't all buy it at once at the quoted spot price. They bid against each other. That is literally how markets reprice. And here's the fourth cliffhanger. What happens if the market realizes the paper promises exceed the available physical supply? Because that's when confidence breaks. And financial markets are built on confidence. Now, I'm not here to scream default every week. That's lazy content. But I am telling you to watch the signals that indicate strain: shrinking inventories, unusual delivery behavior, rising premiums, and repeated claims that demand is unprecedented. When those signals cluster, the physical market is tightening. Now, how does the wealth transfer amplify this? Simple. It's not just one person buying, it's a new baseline of buyers. A decade of inheritances is like a decade of new capital injections, except it's private capital, not central bank capital. And private capital is picky. It moves into assets it trusts. And younger generations often don't trust the same things older generations trusted. That's not an insult. It's experience. They watched crises. They watched bailouts. They watched temporary policies become permanent. So when they inherit, they don't automatically choose the default. They reevaluate everything. Now, let's address a practical point. A lot of people say, okay, but if everyone piles into hard assets, won't they be too expensive? Some will be. Some already are. Real estate in certain areas is run hard. Some stocks are priced for perfection. Some collectibles are pure hype, but silver is still small enough and underowned enough that a relatively modest shift in allocation can move it violently. This is why silver behaves like a coiled spring. It doesn't need everyone. It only needs enough new demand hitting limited supply. Now, the fifth cliffhanger. What if the wealth transfer doesn't just lift silver, but forces a broader repricing of commodities and real assets as fiat currency loses purchasing power? Because when money gets cheaper, real things get more expensive. Not because the thing changed, but because the measuring stick shrank. That's how currency debasement works. Now, you might be thinking, fine, but what do I do with this? I'm not giving you personal financial advice. I'm giving you a framework. You position a portion of wealth into assets that survive. You avoid being 100% dependent on promises that can be broken by policy. And you understand that a wealth transfer is a once-in-a-generation reset. People who catch it early set themselves up for decades. People who ignore it end up working longer than they planned. Now, I want to ask you something, and I want you to answer it in the comments, because it tells me how you're thinking. If you were handed an inheritance tomorrow, what's the first asset you'd buy to protect it? Land, gold, silver, or something else? And second question, do you believe inflation is the main risk, or do you think taxes are the bigger threat over the next 10 years? Drop your answers below. I read the comments, and it helps shape what I cover next. Now, let's bring back the urgency, because this story isn't just big numbers. It's timing. People underestimate how fast conditions can flip. One month, it's plenty of supply, and the next month, it's out of stock. One quarter, it's rate cuts are coming. The next quarter, it's liquidity crisis. Markets move first, headlines move later. That's why the first 24 months matter. It's the early stage of a decade-long transfer. It's the moment when positioning still feels optional. Later, positioning becomes survival. Now, let's talk about the narrative war, because it's real. In any tightening market, you will hear two loud voices. Voice 1 says, this is a bubble, it's over, sell now. Voice 2 says, this is the start of the end, buy at any price. Both voices can mislead you. The trick is to watch the underlying structure: supply, demand, and trust. If supply is constrained and demand is rising, price pressure builds. If trust in paper weakens, physical demand rises. If new wealth is being deployed into hard assets, the pressure sustains. That's the setup. Now, do banks have incentives to talk down silver? Sometimes. Do they sometimes get forecasts wrong? Absolutely. But your job is not to worship forecasts. Your job is to understand incentives and position accordingly. Here's a simple way to think about it. If a large institution benefits when people sell, it will promote selling. If it benefits when people buy, it will promote buying. You don't need conspiracy to understand marketing. Now, I want to walk you through a scenario that explains why this could get explosive without needing a doomsday. Imagine only a small slice of the wealth transfer, say a few percent, decides to buy physical silver as a hedge. Not a crazy percentage, just a small allocation. That allocation, multiplied by trillions, becomes tens of billions. Now compare tens of billions of dollars of demand to a physical market that is not built for sudden surges. That's when shelves empty. That's when premiums spike. That's when delivery gets rationed. And when rationing begins, psychology changes. People don't ask, is it cheap? They ask, can I even get it? That shift is the moment the market changes character. Now, another piece people ignore. Silver is a global market. Demand doesn't need to come only from one country. In a world where many currencies are being managed and devalued, hard assets become a universal language. So when one region tightens, another region feels it. That's why you see reports of high premiums in certain hubs and longer delivery times in others. That's not random, it's a network effect. Now let's talk about the buy button risk. The script you gave mentions mints suspending, dealers quoting delays, and availability shrinking. Whether or not any specific institution paused sales on a specific day, the pattern is something we've seen before in multiple cycles. When demand spikes, retail supply vanishes. And when retail supply vanishes, the average person gets locked out. Institutions can still source large bars. Wealthy buyers can still pay up. But the normal buyer, the person who wants a few ounces, gets told, come back later. Later is usually more expensive. Now, this connects to the generational theme. Younger generations often want flexibility. They want smaller units, they want to test, they want to scale in. Silver is perfect for that, until it isn't available. Now, let's step back to the bigger macro picture that makes this transfer feel like a ticking clock. When debt is high and growth is slow, policymakers lean on financial repression. That means keeping rates below inflation, encouraging spending, and letting the currency absorb the pain. That's not a wild theory. That's how governments historically reduce real debt burdens. If your savings yield less than the inflation rate, your purchasing power gets transferred to the borrower. And the biggest borrower is the state. So in a world of massive debt and political pressure, inflation becomes policy, which means hard assets become necessity. And when necessity meets a wealth transfer, the impact is bigger than any one bull market. It becomes a structural shift in how wealth is stored. Now, I want you to picture this. A family sells a property after a parent passes. The proceeds go to children. The children pay taxes, fees, and costs. They're left with a lump of cash. They look around. Prices are high. Stocks are volatile. Bonds yield less than inflation. They want something real. They buy hard assets. They buy metals. They buy land. They buy businesses. Multiply that by millions of families. That's the transfer in motion. Now let's hit the emotional angle, because this is where retention lives. People think inheritances are free money. They're not. They're the result of someone else's lifetime of sacrifice. And if you waste it through complacency, you don't just lose money, you lose legacy. That's why this topic hits hard. It's not about being greedy, it's about being responsible. Now, here's the sixth cliffhanger. What happens if the next recession or market shock hits right in the middle of peak inheritance years? Because if older holders are forced to liquidate into a downturn and younger inheritors receive cash in a crisis, the reallocation happens under stress. Under stress, people choose safety. Under stress, they run from paper. Under stress, physical demand spikes. So market timing could amplify the transfer. Now, I want to make this practical. If you're building a plan around this idea, you don't need to bet everything on one asset. You need a basket of resilience. Cash for liquidity, real assets for preservation, productive assets for growth, and a slice of metals for insurance. That's the sane approach. The insane approach is being all in on paper promises in a world that is openly managing currency value downward. Now, let's talk about why silver might outperform other hard assets in a surge phase. Real estate is large, illiquid, and slow to transact. Gold is expensive per unit, and many new buyers hesitate. Silver is accessible, tradable, and also industrially constrained. When demand spikes, the most accessible scarce asset often moves hardest. That's not guaranteed. It's a pattern. Now, if you're thinking, but silver is volatile? Yes. And volatility is why people hesitate. Volatility scares weak hands out. Volatility creates the pullbacks that make people think they can wait. But in a true repricing, the pullbacks become shallower and the upside moves become violent. And that's where people get trapped. They wait for the dip that never returns. Now, I want to address something else. The idea that younger generations will prefer digital assets instead of metals. Some will, some won't. But the wealth transfer is not monolithic. It's diverse. And many inheritors will do a simple thing. They will diversify. They will own some digital. They will own some property. And they will want something physical that doesn't depend on an app, a password, or a counterparty. That's where metals re-enter the picture, even for tech-forward investors. Now, let's tighten the storyline. The transfer is happening. The currency is being diluted over time. Traditional yields struggle to beat inflation. Younger investors are skeptical of institutions. Silver supply is inelastic and partially consumed. Put it together, and you get a setup where a small percentage shift can blow out the physical market. Now, here's the seventh cliffhanger. If a physical squeeze happens, it won't look like a movie. It will look boring at first. It starts with longer delivery, then rising premiums, then product shortages, then allocation. Then the media notices, then everyone notices. By the time everyone notices, the easy buying is over. Now, I'm going to give you a simple mental model for what comes next. Think of the wealth transfer as gasoline. Think of inflation as a match. Think of limited physical supply as a closed room. Gasoline plus a match in a closed room creates a fast event. Not because each factor is extreme alone, but because together they accelerate. That's the risk. That's also the opportunity. Now, another quick subscription reminder, because I'm not going to spam you with it. If you want the next part of this story as it evolves, subscribe. We track the signals, not the headlines. Okay, back in. Let's talk about the hidden costs that destroy inheritances. The big three are taxes, fees, and lifestyle inflation. Taxes are obvious. Fees are sneaky. Advisory fees, fund fees, transaction costs, carry costs, management fees. Lifestyle inflation is the killer nobody admits. People spend more because they have more, and the money disappears. Hard assets can protect against currency inflation, but they can't protect you from your own decisions. So the wealth transfer isn't just about markets. It's about behavior. And that's why this topic matters. The winners won't just buy the right asset. They'll avoid the wrong habits. Now, let's tie it back to silver again with a specific example. Imagine a person inherits $100,000. They decide to allocate 10% to physical silver as insurance. That's $10,000. In a normal market, that's a simple purchase. In a stressed market, that $10,000 might not even be fillable immediately at a fair premium. Multiply that by millions of inheritors. That's why small allocations matter. Now people ask, but what if prices drop after I buy? That's always possible. Markets move in waves. The question is, what is your time horizon? If your horizon is weeks, you're trading. If your horizon is years, you're positioning. A wealth transfer is a positioning environment. Now, I want to address one more narrative. The idea that silver is too small to matter. That's exactly why it matters. Small markets move faster. Small markets are easier to disrupt. Small markets create the biggest percentage moves because the base is smaller. That's not a guarantee. It's a structural truth. Now, at this point, you might be wondering, okay, but what's the catalyst? The catalyst is not one headline. It's the accumulation of pressure. It's more inheritances, more debt, more printing, more industrial demand, more skeptical investors, more physical tightness. And then one day, a spark. Maybe it's a sudden delivery crunch. Maybe it's a policy shift. Maybe it's a recession. Maybe it's a geopolitical shock. Whatever it is, the conditions are what matter. Now, let me make a prediction in terms of behavior, not price. As this transfer accelerates, you will see more mainstream conversations about alternative assets. You will see more financial advisors suggest real assets allocations. You will see more families talk about keeping value instead of maximizing returns. That is the psychological shift. And when psychology shifts, markets follow. Now, the last part of this script needs to land hard, because I don't want you leaving with a vague feeling. I want you leaving with a decision. Here's the decision. Do you treat this wealth shift as background noise, or do you treat it as a once-in-a-lifetime window? If you treat it as noise, you'll keep doing what everyone does. Wait, hesitate, outsource, react late. If you treat it as a window, you'll build a plan now in calmish times before pressure peaks. Now, I'm going to give you a final cliffhanger to carry into the next video. The wealth transfer doesn't just change who owns assets, it changes what assets are even desirable. Because when a new generation takes control, the default portfolio gets rewritten. And the default portfolio, the next generation, is already telling you the future. Less blind faith in paper, more demand for tangible scarcity. That's why you're hearing more about metals, land, and real assets again. So here's my closing message. The wealth is moving. It is moving whether you pay attention or not. And the people who win will be the ones who understand that the measuring stick is shrinking, the legacy is being handed over, and the scarce assets are where the crowd will rush when fear returns. If you got value from this, hit like so more people see it. Subscribe so you don't miss the next piece. And answer those two questions in the comments. What asset would you buy first? And what do you think is the bigger threat? Inflation or taxes? Now, I want to slow down for a moment and make the mechanics crystal clear, because this is where most people get lost. They hear $45 trillion and they picture a single giant vault door opening. That's not how it works. It happens in thousands of smaller events. A retirement account beneficiary form gets triggered. A property gets sold because the heirs don't want to manage it. A life insurance payout hits a checking account. A trust distributes funds. A grandparent starts gifting early. And in each event, there's a fork in the road. Fork one is keep it in the system. Now that means banks, bonds, broad funds, and a lot of exposure to rules you don't control. Fork two is pull some of it out of the system. That means tangible assets, direct ownership, and fewer counterparties. Here's what nobody likes to admit. The system is designed to keep you on fork one. It's convenient. It's socially approved. It's what your banker understands. And it's what creates fee streams for institutions. Fork two is harder. You have to think. You have to store things. You have to make choices. But fork two is how people protect wealth when the measuring stick is getting weaker. Now, let's talk about the most brutal part of this transfer. The silent losses that happen before the inheritor even makes a decision. Estate settlement can take months. In that time, money sits, and sitting money bleeds in real terms when inflation is elevated. Then come taxes, then legal costs, then probate fees. By the time cash actually lands, a chunk is already gone. Not stolen, just quietly reduced. So when I say the transfer is urgent, I don't mean panic buy something tonight. I mean understand the environment and build a plan before you're forced into rushed decisions. Now, let's bring in a piece of silver market structure that matters a lot for retention, because it's where people go, wait, what? Silver trades in two worlds at the same time. One world is real world metal, bars, coins, industrial feedstock, refining, shipping. The other world is paper exposure, futures, options, leveraged products, silver that exists as accounting entries. In normal times, those two worlds move together. In stress times, they separate. And when they separate, the physical world starts setting the rules. Here's the key insight. The paper world can create an unlimited number of claims. The physical world can't create an unlimited number of ounces. So when enough people decide they want physical, the paper market has to either deliver, cash settle, or change the rules. And that's when the story stops being a price chart and becomes a trust event. Now, another thing that makes this wealth transfer different from past ones is what I'll call crisis memory. When younger generations grew up in a world where stability got rebooted every few years. So when they inherit, they don't automatically assume the market is a sacred machine. They assume it can hurt them if they're careless. So they diversify into things they can see. And silver is one of the few things that still feels old school real while also being tied to modern tech demand. Now, let's do the inflation math in a way that hits. Imagine inflation averages 8% for several years. At 8% inflation, purchasing power halves in about 9 years. That means $1 million inherited today can feel like $500,000 in real terms before the decade is over, even if the statement still says $1 million. And here's the trap. People confuse nominal with real. They say, my account didn't go down. Meanwhile, their lifestyle gets more expensive. Now I want to do a viewer question segment because it makes this practical. A viewer asked, if the wealth transfer is real, why doesn't it show up as one obvious spike in markets? Because transfers hide inside normal transactions. A home sale looks like a home sale. A portfolio rebalance looks like a rebalance. A trust distribution looks like paperwork. But add it up across millions of families and it becomes a tidal force. The second part of their question was, if silver is the play, is it too late after a big move? Too late depends on your objective. If your objective is to catch every short-term swing, you're trading and you need a trader's plan. If your objective is to protect purchasing power and participate in a long-term repricing driven by structure, then late is a different concept. A market can be up a lot and still be early if the imbalance is growing. Now, I'm going to add a warning. I wish more people would say out loud, silver is not a magic ticket. It's a tool. And like any tool, it works best as part of a broader plan. So here's a simple plan structure for someone inheriting wealth. Step 1. Decide what portion must stay liquid for bills, taxes, and emergencies. Step 2. Decide what portion must grow in productive assets. Step 3. Decide what portion is insurance against systemic nonsense. That's where metals often live. Now, here's a cliffhanger that matters. A small slice of the wealth transfer can still overwhelm a small physical market. It doesn't need everyone. It only needs enough new buyers showing up consistently. That's why now matters. Not because you can predict the exact week of the next move, but because physical markets can flip from available to unavailable faster than most people believe. And once the conversation shifts from, is it cheap, to can I even get it, the market changes character. Now, people ask, coins, bars, or paper exposure? Understand what you own. Paper can track price, but adds counterparties. Physical adds storage and premiums, but removes counterparty risk. In a calm world, paper feels convenient. In a stressed world, physical feels like control. Now, I want to connect the loop back to the opening. What happened is that the transfer began, and it's accelerating into the years where the demographic wave crests. The money is moving into new hands, and those new hands are making different choices. Those choices are pushing demand towards scarce real assets at the same time the currency is being diluted. So don't let your plan be hope. And don't let your plan be, I'll figure it out later. Build a framework now. And as you think about all of this, drop your thoughts in the comments, especially if you've seen premiums rise, delivery times stretch, or friends suddenly talk about metals again. Those real-world signals tell us more than any headline will, and your observations help everyone here. Now, let's add one more layer that people keep skipping, scale. If the near-term transfer is measured in the tens of trillions, you don't need some fantasy all-in allocation to move silver. You only need a small percentage. Picture this. A year goes by and a slice of inheritors decide, I want 5% of my new wealth outside the system. 5%, not 50, 5. That money doesn't all go to silver, but even a fraction of that fraction is enormous. Silver is a market where physical inventory and annual mine supply are measured in ounces, not in infinite digits. And a big part of that supply is tied to other mining activity, meaning you can't just snap your fingers and create more metal quickly. So when new money shows up, prices don't rise smoothly. They lurch, they gap, they overshoot, then pull back, then surge again. That's why silver's history looks violent. And when people talk about the gold to silver ratio, the point is not to worship a perfect number. The point is to understand compression. When gold holds value and silver is tight, silver tends to play catch up, and that catch up can be fast. So here's the practical takeaway. If you believe the wealth transfer is real, and you believe currency purchasing power will keep getting pressured, then you don't wait for a perfect moment that might never appear. You build a position in layers, you keep some liquidity, and you treat metals as long-term insurance with upside, not as a lottery ticket. Because the real risk isn't buying and seeing a dip. The real risk is doing nothing, then watching availability vanish and realizing the dip you waited for was the last calm window you'll see. Quietly, watch the signals, not the noise. Delivery delays, rising premiums, shrinking visible inventories, and the moment dealers stop quoting firm prices. Those are the early warning flares. And if you ever see cash settlement encouraged language, that's your hint that paper's trying to escape physical reality. When that happens, the easy part of this story is already over, and I'll see you in the next video.